What's up, guys? This is Chris, and in the past 72 hours, we have had a crazy time in the stock market. On Tuesday, you saw such a huge drop, almost 4% down in the NASDAQ before it came back. But again, here today, we have to talk about what seems to be the stock market correcting, or some might say crashing, once again with the Dow Jones over 500 points down, and the NASDAQ in particular today almost 3.5% down. So in this video, you're gonna get 3 big tips to follow for understanding how to navigate through this difficult time in the market. We're going to talk about the truth. What can you do about this situation? How long do I think this is personally going to last? So as I mentioned in my previous video about 10 stocks to buy into weakness in the stock market, I did say that the 2 big reasons why the stock market has been struggling of late is because of rising interest rates, specifically in the 10-year bond yields, which provides competition to buying stocks and not putting your money anywhere else, especially with high growth tech stocks that may have really high valuations. The second thing is that simply the stock market has gone up huge since March 2020, and since then we haven't had a lot of big pullbacks, especially year to date until now. What I mean by that is that throughout the history of the stock market, and this is very important to know for everyone who feels panicked or feels worried about their investment, since the beginning of the stock market, year after year, there have been plenty of corrections. Corrections are 5 to 10% pullbacks, and they are what they sound like. It corrects any froth in the market, times when people are buying way too heavily at all-time highs and feeling like the market can never go down. That amount of complacency is usually never a good thing. And by correcting, 5%, 10% down, people, flush some people out that were just gambling or speculating. And people that are more of a long-term investor, they're waiting for discounts like this to start putting some money to work. All right, guys, so we're gonna dive right in here. We have the NASDAQ composite here. This is, of course, the bellwether, the symbol of all tech stocks, and you can see here that since the lows of the pandemic, right, in March, we've had plenty of pullbacks along the way. Right here from the low, there's many ups and downs along the way. It's not too surprising that especially the September to November period was a really rough 2 or 3 months there. And since then, we've had much smaller pullbacks. We had the GameStop related pullback there. And so right now we're kind of in an area where, we've made new highs and we need to pull back. It's kind of normal. Obviously right now it's definitely hurting a lot. It's definitely bigger than we've had in quite some time. But, right now I will say there is potentially more to go. If you look at some of the levels here, we hit this bottom on Tuesday, around $13,000 in the NASDAQ, and we didn't quite get there again today, but could always happen still. And below that, you're gonna see some support here, around 12,600. And if we really went lower than that, that would be 12.2, but I personally think that this is as far as the pullback goes to 12,600 if we get there. And overall, you're looking at a pullback all the way down there from the high of 14,200 on the NASDAQ would be about 11%. Going back through the history of the stock market, if I just go back to the most recent recession we had in 2008, 2009, that was one of the biggest recessions and downturns we've ever had in the market, definitely in recent memory. And, look what happened. After we bottomed in 2009, it should come as no surprise that the market's not going to go straight up every single day or every single week or every single month. Look at this. Like going to 2010, right? So we had a really big recovery in 2020. 2009, very similar. a pretty big bounce back up, right? Believe it or not, the NASDAQ was 1,200 at one point, right? 12 years ago. Doubled basically to 2,300. And from there, you start to see some pretty big moves, and eerily, the chart looks pretty similar, right? So 2,300 on the NASDAQ, pulls back to 2,100. If you do the math, guys, what is that? About 10%. Okay, negative 10% down. All right, this is not strange stuff. Bounces back, okay, goes up to 2,500. What happened then? You had pretty big moves down, okay, to 2,070 thereabouts. And this is over the course of April, May, June, July, August, September. It's a pretty long time, to be honest. I'm not saying this is definitely going to happen this time where we have a really protracted downturn. But at the end of the day, what happens? It bounces back over time, makes new highs, 2,500, 2,800, before you get another downturn here. Okay, so the whole point, the moral, the lesson, what to take out of this is that simply this is going to happen, whether you like it or not. There's going to be times where the market goes down 10% in a month, in a week even, 20% over a couple of months. You have to be willing to take it if you're going to be in the game in the long run. A lot of people like quick money, right? Easy money. I'm going to buy this stock. It's going to go up 50%. I'm going to pull out. I'm going to buy another stock, and so on and so on. That's not how this works. At the end of the day, the best thing that you can do is follow these steps and strategies and tips that I'm about to show you. So now that we know corrections are totally normal, let's go back and put things even more into perspective. So tip number one is to really focus on why you wanted to invest in the first place. Why were you bullish in the first place? In the broader economy, in the market, right? We know that there is tons of stimulus to come. There is tons of money flooding in. Even if yields go up in bonds, I don't think that in the bigger picture, you want to all of a sudden sell off all your stocks and be afraid of the market. Besides the amount of liquidity out there, increasing earnings across the board, and those earnings that have been reported over the past month or so have been really, really great. They've been phenomenal. They're beating estimates by and large. The second thing, right, is that a lot of companies are riding growth trends that are going to continue well beyond today or tomorrow or the next month or even the next 6 months. And if you're invested in companies doing e-commerce or artificial intelligence, software, electric vehicles, it doesn't really change the business what happens today if the market goes down and the stock goes down 5% or 10%, right? Those do not impact the real financial results of a company. And if you were bullish about a company yesterday, why aren't you bullish anymore today just because the stock went down? Do you really need the money that badly? Are your expectations so out of whack that stocks have to go up every day, right? You need to think about this and really, reset your mental state. I know a lot of people, feel like they're a genius, right? When in reality, a lot of stocks have been going up for a long time. And this is the point really where people show their stuff. And if you have any clue about investing or even trading, right? Understand, if you're gonna be in it to win it, you need to take some punches. And if you're in some good long-term stocks with good trends, you should not be worried about what happens in the short term. All right, and the third tip here, and this is very, very important to understand how to manage your portfolio. A lot of people going into this pullback and this downturn have invested way too heavily at all-time highs. I always recommend a person keep 20% of their money in cash. If you have margin, that's great. Use that only sparingly and strategically. As the market pulls back even more, then you want to use it as buying power, that's fine. But you should not be all in and then be doubly all in by using margin, borrowed money, to invest at all-time highs. Doesn't make sense, especially in very, very risky names. And if you are in very risky names, by the way, I'm sure at this point in time, you know that was not a good idea. And I'm talking about CCIV. Let's name some names here. CCIV, trading 6-7 times the IPO or the SPAC valuation, from $10 per share to $70 per share. Did that make sense? No. A lot of people still invested heavily at all-time highs. Anyway, you have to step back and think, I'm only going to put 5 to 10% of my money into risky investments, if you want to call it that, or even if you want to call it a safe investment. If you're putting tons of money in at all-time highs, at some point it's got to pull back. And if you're fine riding out the waves and you're okay with your account going down 50, 60% like CCIV has, or 70%, that's fine by me. But I think for most investors, it's going to be difficult holding on to that. Emotionally, that's going to wreck you. And it's just not really the best financial investing strategy out there. So again, make sure you keep some cash and keep that buying power, because guess what? Maybe you like CCIV. You don't have to put all your money in all-time highs. Wait for a pullback. It's going to happen. So you could buy some shares right now in the 20s or even lower if it dips. Like for me, like my investments, GIK, IPOE, for example, those have come down a lot, and I'm okay with buying them, because going back to point number 2, was it that you want to invest in companies with long-term trends, and if you like it, you should be able to like it at lower prices and buy at a discount. And if you keep that cash, you will be able to. If you're constantly fully invested, then you have no power, and power is everything, right? On top of that, making sure you keep your risky investments to a minimum, right? I like to say 5 to 10%, or even less than 5% if it's really a spec stock. You want to keep your positions in general at a reasonable size. And the bigger your account, the more diversification you need, in my personal opinion. So for most of my stocks, they're going to be like the 5 to 10% range. I want to make sure that I'm not too heavily invested in a stock to the point where if that stock tanks, then my whole account is tanking. I don't want to be in that position. So my biggest position, my full bullish, most loved stock out there, SE, is still going to be 20% or so max of my portfolio. A lot of easy money has been made out there, but it's time to really hunker down, study. If you're doing the wrong things in the market, you need to wake up and realize how to fix that. And you can start doing that by watching some of my videos and some of these tip videos like this, to really make sure you're researching, you have a safe strategic plan, and you have some idea about how the market really works. Don't let short-term paper losses affect how you want to invest and how you want to build generational wealth. Until next time, my friends, stay well, and really, as I always say, invest responsibly.